Good evening, ladies and gentlemen. Welcome to Cass Business School. I'm Stephen Haberman, Dean of the school. I'm delighted this evening to be welcoming Dr. Olivier Blanchard, former Chief Economist of the IMF. And he will be delivering our 31st Mais lecture. To remind those of you who don't know about the Mais lecture, it was established to honour Lord Mais, former Lord Mayor of the City of London and former Chancellor of City University London. He played a key role in establishing a centre of excellence at Cass in banking and international finance. This is now part of our thriving Cass Faculty of Finance, one of the largest such academic groupings in Europe, home to over 60 academics, 40 PhD students, and around 1,700 undergrad and postgrad students studying various aspects of finance. Academic and practitioner-oriented research is very important at Cass, very important to Cass, and it's thriving and very highly regarded. Let me just speak for about 1 minute about that. UK universities, as you may know, participate in a national review roughly every 6 or 7 years, and the results were published from the most recent one last year. This said that 84% of Cass business and management research was rated as either world-leading, what they call 4-star, or internationally excellent, what they call 3-star, the top two categories, 84%. This places Cass in the top 6 of the over 100 universities conducting business and management research. This top 6 is very important to our students at Cass and indeed to our corporate clients. It means that the academics who teach our students and supervise their work are preeminent in their fields and indeed are making great strides in helping to advance those fields. Others also rank our research as being number 2 in Europe for the impact that it makes on the real world of practitioners and policymakers. And this combination of rigour and relevance is something of which we, indeed I, am very proud, and something which makes us special. Returning from Cass to the Mais lecture, it has an outstanding pedigree as a set-piece event for policymakers. Previous lecturers have included all the governors of the Bank of England since 1978, chancellors of the Exchequer, individuals who became Prime Minister, the President of France, Nobel Prize winners, the Chief Rabbi, heads of the ECB, IMF, Federal Reserve, and Bundesbank. For example, Eddie George used his 1997 lecture to comment on the newly acquired independence of the central bank. Mervyn King, in 2005, explained the inflation targeting regime to be used by the bank, and many will remember his analogies with a goal scored by Maradona in the 1986 World Cup in a match against, well, you know who it was against. The principal theme of the lectures has been monetary policy, although Sir Samuel Britton and Chief Rabbi Jonathan Sachs gave wide-ranging lectures on the nature of the economic system in which we live and work. So our speaker tonight follows in a very proud tradition. And let me just say a few words of introduction about it. Last week, the Washington Post called Dr. Blanchard the smartest economist you've never heard of. I think they were being, that's a compliment, I think. Yeah, you can never tell with journalists. But let me add some background to help us out. So born in France, he spent most of his professional life in Cambridge, US. After obtaining his PhD in economics at MIT in 1977, he taught at Harvard and then returned to MIT in 1982. He was chair of the economics department from 1998 to 2003. In 2008, he took a leave of absence to be the economic counselor and director of the research department of the International Monetary Fund. So for 7 tumultuous years, he was the IMF's chief economist. According to a colleague, he changed the way that the fund looked at the world, and he changed the way that the world looked at the fund. In the process, he was instrumental in helping the IMF pull the global economy back from the brink of economic disaster. Speaking of Dr. Blanchard's role at the IMF, Professor George Akerlof, Nobel laureate, said he was exactly what the world needed at that crucial moment. Professor Blanchard is now the Fred Burtson Senior Fellow at the Peterson Institute for International Economics in Washington. He also remains the Robert M. Solow Professor of Economics Emeritus at MIT. He's a macroeconomist who's worked on a wide set of issues, from the role of monetary policy to the nature of speculative bubbles, to the nature of labour markets and the determinants of unemployment, to transition in former communist countries, and to the forces behind the recent global crisis. He's worked with numerous countries and international organisations. He's the author of many articles and books, including 2 leading textbooks on macroeconomics. I've nearly finished. He's a fellow and past council member of the Econometric Society, a past vice president of the American Economic Association, and a member of the American Academy of Sciences. So, the format for tonight is that Professor Blanchard is going to give his lecture. Then he's very kindly agreed to take questions, and my colleague, Professor Thorsten Beck, will share the Q&A session. And then there'll be an opportunity for you to meet with him, and indeed with each other, outside over drinks and networking. So, can we please now welcome Professor Olivier Blanchard.
Thank you for the very kind words, and I'm honored to be added to the list of previous speakers. It is indeed a great honor. I've left the fund 2 weeks ago, and I'm basically, I think, in the process of trying to put my thoughts together. It is very difficult to do when we're in the middle of the action, and my hope is to do this, but it has only been 2 weeks, and I'm not quite there yet. I thought that I would try to put my thoughts together on the topic that is here, which is rethinking macroeconomic policy. This is something that clearly we have all thought about for the last 7 years, but in addition, as some of you know, I've organized 3 conferences on the topic, which really had all the major policymakers and academics, and I've learned a lot from it. And this is an attempt to distill where I am. It is clearly not the finished product. You'll have to invite me again if you want. But this is where I am. So this is what I'm doing. So I'm going to start by giving you what is to some extent a caricature of what the macro policy framework is. As I said in the first slide, I'm really thinking about stabilization policy, not growth, not structural reforms. These are important, but that's not the topic, which is basically how to limit fluctuations. And I think by 2007, there was a sense, which turned out to be completely unjustified, that we had converged on a way of doing policy. First, I think the vision was, given that there had not been major crises in advanced economies, that you had regular fluctuations around a fairly smooth trend, and the idea was to basically deal with these fluctuations. They had different causes, different shocks causing them, but they were fairly regular, and you could basically think of the world in those terms, fairly stationary, fairly analogic, to use the technical term. There was an enormous emphasis on one tool, which was monetary policy. Fiscal policy was thought to be more or less unusable, and other policies were not really considered. And in terms of monetary policy, there was an increasing consensus that the way to do it was twofold. The first one was to stabilize inflation, And the idea was not just to stabilize inflation, but the models we had suggested that if you stabilize inflation, then output would be roughly at potential. So that this was basically a way of knowing where you were relative to potential. If you stabilized, then you were close to potential, and that was good. So this was the objective, inflation targeting, and you referred to Haberman's lecture, which I assume made that point. And that the way to then get there, achieve the inflation target, was some kind of interest rate rule, in which if inflation was too high relative to what you wanted, you increased the real interest rate, your policy rate, and if it was too low, you decreased it. And there was an enormous amount of work on the exact form of the rule. It was called the Taylor rule in the US. There was a lot of refinements about the rule, but much of the work was about that. And the notion was, if you do this, well, things will be fine. Output will be potential, inflation will be stable, and that's all you can hope from stabilization policy. Now, I caricature just a bit, but not very much. The point in the last slide is relevant, which is that as we were converging to, we're thinking along these lines in advanced economies, emerging market policymakers were much more aware that things could go wrong because they were still exposed to certain stops and various other things. And so I think that the crime was really committed in advanced economies. There was much more realism already in emerging markets. And in many ways, I think what we've learned is some of the lessons that they had learned earlier that we had not assimilated. So the question is, why should we rethink? Well, obviously it didn't work. I think that's the statement. But the question is, why is it that we were wrong? Is it that we have misperceived reality? Reality had changed, and therefore we need to rethink in the light of new reality? Or is it that our perceptions of reality were wrong? And I think the answer is both. Reality has changed. We're now facing the same economy as we were 20 or 30 years ago. In addition, there were things that we just didn't see and we should have seen. So what I want to do is talk a bit first about how reality has changed, having in mind not all the dimensions in which reality has changed, which are too many, but the ones which are relevant for policy making, and then how our perceptions have changed. And when I've done this, then I will basically look at 4 aspects of policy that I think we have to rethink. And that's the plan of the lecture. So the 2 warnings there, I think that I've already made them. The first one is, I'm not there yet. None of us, and surely not I, have an integrated view of exactly how policy should be done. I think we're all feeling our way towards something. And I think I hope that what I say represents some progress, but we're not there. And then the other is it's really just stabilization policy. And there's a whole set of issues about how to increase growth, how to increase productivity growth. That's a different set of issues, which we're just not going to deal with this book. So, reality. So, in what way is reality different from what it was? And again, with having in mind implications for policy making. So, on the real side, I think there are, again, many things, but 2 trends which matter very much for policy making. And that have been summarized by the term which I think was coined by my ex-boss, Christine Lagarde, called the new mediocre. Now I'm not sure about is the new part, but mediocre is one word, will not work. New mediocre has more of appeal to it. But I think there are two different dimensions, and I think it's important to keep that in mind. They're both linked, but different. The first one is we have entered a world in which growth is likely to be lower than it was. And that comes from aging, this we know and we can measure, and it comes from lower productivity growth for reasons which we don't quite understand. But it is fairly clear that productivity growth is lower than it was, and so the sum of the 2, employment and productivity growth, means a lower growth. And this has all kinds of implications. You do not do the same policies in a high growth environment, in a low growth environment. The other, which has been called secular stagnation by my friend Larry Summers is different. And it says even to sustain even that lower level of growth, that lower level of output over time, you're going to need lower interest rates. And that comes from the notion that there is high saving in the world for various reasons. There is low investment, and so in order to reconcile saving and investment, you need low interest rates. And rates are going to be low for a very long time. Low safe rates are going to be low for a very long time. Now, I think this is a really important issue, and let me just show you the slide, and then I'll come back to it. This is the evolution of real safe interest rates. So interest rates on 10-year real government bond yields using expected inflation since 1990. And that graph is quite striking. The interest rates have steadily decreased. If you didn't know there was a crisis, you would not know. And basically, it looks like the trend started long before the crisis and will continue. Now, if this trend continues, even if you think that some of the end is due to the crisis, then we're going to be in the world of very low real rates for a long time. This being said, if we go back to the previous slide, we do not fully understand why these rates are low. There are various explanations having to do with saving in China and increased desire by various financial institutions to hold safe assets, which decreases the safe rate. The question is whether these things will continue. But I think the trend is so strong, it's unlikely to reverse anytime soon. And at least the expectation is that real rates will remain very low. So you're going to be in a world of low growth and low real rates. On the financial side, then there is the legacy of the crisis. And the legacy of the crisis is that there is higher public debt, and higher private debt, not everywhere, but in many countries, corporates are highly leveraged. Households are leveraged in a number of countries, so private debt is fairly high. And this has an implication, which is again relevant for policy, which is when you have low inflation and low growth, then deleveraging, decreasing your level of debt relative to GDP or relative to your income is very difficult. In history, the times when the debt to GDP level has decreased was either because GDP was increasing fast or inflation was eating away at the returns and decreasing the real value of the debt. Without both, we're basically going to be in an environment of high debt for a very long time. And I think this has to be taken as a given for the next 10, 20 years, which is not going to be able to get out of it very quickly. So I think this is the way in which reality has changed. What about perceptions? And I think perceptions have changed a lot. Again, we had a sense of that when I had a chapter in my textbook on the Great Depression, but it was in the history section. We knew that it could happen in some emerging market countries, but we thought it was because they were young and sometimes the policymakers didn't know how to do things. But I think we've learned, no, it can happen to us, and this is a big lesson. And the way I think about it is, and that's a lecture I gave at the American Economic Association meetings in December, I think of dark corners, which is that most of the time, not now because we're still kind of getting out of the crisis, but most of the time in the future, we're likely to be in a fairly normal environment where nothing tremendously surprising happens. But there are places in the state space, if you want, in which things can go very wrong very quickly. These are what I call the dark corners. So most of the time it's flat and nice, but when you get to the corners, things can go very wrong. What happens in those corners, you basically have large multipliers, or you have multiple equilibria, and in that environment, strange things can happen. Policy may work, may not work. There's multiple equilibria in the way policy works. And these are places where you surely don't want to be. And fighting the slide. If I had more time, I would go into what these multiple equilibria or these dark corners are. I'm just going to sketch it. I had more slides, but realized it would take too much time, sorry. Yeah. So the first one is one which we had seen during the Great Depression, but not since then. It's the interaction between deflation and the zero lower bound. So you need to decrease the interest rate to help the economy. You get to zero, and that's more or less where you stop. And you know that there is QE, but it's not at all as good. So you cannot get the rate lower than that. That's not enough to push the economy up. The economy goes to deflation. The more deflation, the higher the real interest rate, which further decreases economic demand and output, which leads to more deflation. And we had seen this in the Great Depression, in which deflation reached 15% at some point in 1932. But we've seen a mild version of this. It's very, very difficult once you're there to actually get things up, at least for monetary policy, you have other instruments if you have that. But that's the place where you don't want to go. I think nobody wants to go back to the zero lower bound in the future. It is really not a good place. Then on the financial side, you have interactions between what you can think of as risk premium and debt levels. So for public debt, public debt gets very high. The investors think that there's a risk that will not be repaid. They ask for risk premium. This makes debt go up even faster. The slides are moving faster. Wow, they have moved a lot. Not to move anymore. Right. So I put this very far over. So investors want a high risk premium. This leads to even further increases in debt, which leads to a higher risk premium. So it's a solvency issue. But in that world, you can have multiple equilibria extremely easily, which is if the investors think that you cannot repay and ask for risk premium, even if you could have, then the fact that they ask for the risk premium means that you can't. So you have the self-fulfilling equilibrium. You have exactly the same thing in the financial sector, in which this is bank loans, but drawn larger, which is people think that the bank is in trouble, they want their money, they take their money out, they have fire sales on the asset side, this decreases the value, it justifies the fact that people moved away in the first place. So again, it could be intrinsic, the bank could really be in trouble if it's highly leveraged, but it could be multiple equilibrium again, which is if for some reason people believe that the bank is not healthy, they will take their money out, force the bank to do fire sales at fire sales prices, and the bank will go bankrupt, even if fundamentally it was right. And we've seen examples of this. And we've seen interactions between the public debt and the private debt or the high leverage of banks, and all this is basically the story of the crisis. So this is what I mean by dark corners. When you get to very high levels of debt or high levels of leverage, things can go very wrong very quickly. There can be multiple equilibria. So let me just now move those slides myself. So, I have two graphs, but they are extremely familiar. This is the evolution of CDS spreads, which was exactly what happened in Europe when people decided that maybe Spanish debt or Greek debt was unsustainable. Very large increase in risk premium, which made debt go even faster. And then this one is about the interaction between sovereign risk and bank risks. And you know the story when Ireland, basically when the state in Ireland had to assume the debt of the banks, then it became itself subject to doubts about its sustainability. And the two spreads on banks and the state started moving together. And that was a serious issue. Ireland has got out of it, but it was very tough. So dark corners is what I mean here. So now I'm going to move to examples, but let me give you what my general principles are in thinking about redesigning policy. The first one is that there's an interaction between the way reality has changed and the way we've changed perceptions, which is that probably there are always dark corners, but we're much closer to them as a result of the crisis than we were before. If dark corners have to do with high debt, then we have high debt, we have high leverage in parts of the economy. So we're much closer to dark corners, I think, than we were
say 10 years ago or before the crisis, partly as a result of the crisis. I give you two examples, and the first one is if you have high debt, high public debt, and there is low growth and low inflation, then you stay with high debt. It's very, very hard to decrease it so that the solvency and the liquidity risk remain. If you have low inflation and low real rates, then the probability that you hit the zero lower bound is much higher than if you had high inflation and high real rates. So again, you're much closer to that dark corner. So my sense is it's very difficult to design a policy for all times, especially for times of danger. I think three things. The first one is try to avoid the dark corners at nearly all costs. And we've learned that when you get there, you're really in trouble, and you get 5 years of very low output, high unemployment at best. So avoid the dark corners as much as you can. You're probably not going to avoid them all the time. So if you fall into or you enter a dark corner, take aggressive measures to get out. Probably more aggressive than were taken, although some of the measures were very aggressive, but we could go even further. And then in normal times, go away from these corners. I think we want simple policies, but again, knowing that somewhere in the distance, the dark corners are there, and it introduces some asymmetry, for example, in the way we use the interest rate in interest rate rule. So let me develop some of these points. I'm not going to talk about the last one. I can do it in the Q&A, but I'm going to focus on the first two. So the four issues that I want to quickly talk about, each of them could be a full lecture. Yes. I think this is it. Yeah, it's probably it. Okay, and I need a full screen. Good. Good. Same four issues. So you just list them and then go for each one. So the first one is the role of macroprudential. This is something which was not discussed seriously before 2008. It's now very big. The question is what it can do. The second is something that I've not convinced any of my central banking friends to consider, which is whether the inflation target of 2% in this environment of low rates is really the right thing. The third one is fiscal policy. I take as a given that there is high public debt, it's not going to go away, and the question is, in that environment, can you use fiscal policy for stabilization purposes? And then the last one is at the zero lower bound. And you want at the zero lower bound, and you want to do more, the economy needs it. You have a choice between buying assets, which is the standard way of doing things, or buying goods, which is the non-standard way of doing things. And the question is, we've gone with assets, but maybe we should be discussing the alternative. And I'm going to come back to that. Okay. So, macro pool is really a major conceptual change relative to where we were. Remember the simplicity of policy pre-2007. You just had one goal, inflation target, you had one instrument, the policy rate, and if you do things right, that's it, you don't need to do anything. Macro pool is basically saying, well, you have to intervene in various races. It's very much like antitrust or industrial organization. Basically, you have to intervene. There are many, many distortions you have to intervene. I think it is understood that we need macro instruments, that what we had before was just not sufficient. And the hope is that by using these instruments, we'll be able to avoid the financial crises that we've had in the past. So let me just make a few remarks about that. So you can think of a great set of instruments, but in fact, in the end, I think it's mainly two boxes. The first one is housing. There's a long tradition of both housing cycles playing a big role and using instruments to try to control housing. And then financial, which is basically trying to avoid too much leverage in the banking or the shadow banking sector. I think these are the main two dimensions. So think in the first case, think of LTVs, loan-to-value ratios as an instrument for housing, and then think of capital ratios as an instrument for limiting leverage in the financial system. Now, the first question is, do they work? And I think we don't know yet. For housing, we have more experience because loan-to-value ratios have been used in many countries for many years. And my sense is if you're willing to really use it, they work. They don't quite smooth housing completely, but they really slow down the boom, and they can help in the bust. On the macro-prudential tools on the financial system, I think there is just discovery. We don't know yet. We don't know what an increase in the capital ratio does to the behavior of the bank. We have ideas, but we just don't know how to use these things. But we shall eventually. The main issue I want to raise is the political feasibility issue, which is that these measures have very strong distribution effects. There are some groups which really suffer directly. Now, interestingly, it's true of interest rates as well. But somehow, for interest rates, it's accepted that it's going to have an effect on savers, but nobody very much complains. These are much more targeted, so still trying to get ahead of them. And therefore, the groups which are affected tend to be very local. And here, I think we're accumulating evidence on this. So, on housing, there's a fascinating piece by Stan Fisher, who was the governor of the Bank of Israel, and tried to use and used loan-to-value ratios, and basically got phone calls from the Prime Minister explaining to him that the young people who would be affected by the loan-to-value ratios, but also the people who voted for him in the elections with extension twice. And the political constraints were very strong. He was able to do something, but clearly not as much as he would dream. And on capital ratios, I think we know less, but the evidence is not extremely comforting. I gave two examples here. The first one is, you know that in Spain, they have done dynamic provisioning, which in retrospect is a very good idea, except that they stopped basically doing dynamic provisioning in 2004, when the bank said, look, we've provisioned enough, stop it. You're basically killing us. The other countries are forcing the banks to do the same, let's stop. If they had continued, I think Spain would be in a much better position than it turned out to be. Clearly political pressure from the banks. Now, at the other end, suppose that there is a financial crisis which is due to bad behavior by banks, which sometimes happens, and assets go down in value and the capital ratios drop like a stone. What you should do at that point is indeed allow for lower capital ratios in order not to cut lending and let the banks go back. But politically, then you get the other side is going to tell you, look, these guys screwed up badly. Now you want to give them a pass, allow them to have very low capital. This is completely unacceptable, and the political pressure to basically do it will also be there. So the political constraints, I think, are very serious in the case of macroprudential tools. And some of the people at the bank, I think, I feel, are deeply aware of these issues. So I think he wants me to go faster. So I think that an issue, tell me what I'm doing wrong. I think I'm doing nothing wrong. So I think an issue is we have to think about is whether we want to use financial regulation or macro The difference between the two is financial regulation, think of capital ratios. You basically fix the capital ratio at some level, and you don't change it. You don't try to change it all the time. Macro-proof will be changing the capital ratio as a function of the state of the financial system. Now, in principle, the second one is better than the first. It's better to move something than to keep it constant. It's a constraint. But once you take the political economy into consideration, it may make sense to have a constant capital ratio of, say, 20%, and not change it, probably something which moves between 5 and 25, once you take into account that. And there's an interesting study, I'll just give you that, and then move on to the next one. So there's a study at the IMF which has looked at the banking crisis since the 1970s in both advanced and emerging market economies, so 147 of them. And they have computed the losses of the banking system in each crisis. Now that's not easy to do, they have to make assumptions, but they did the best they could. Then they looked at the risk-weighted capital ratios that would be needed to cover the losses, right? And what they concluded is if the capital ratios, the risk-weighted capital ratios, had been in the range of 15 to 22%, that comes from different assumptions about the construction, then in 85% of the banking crisis, it would have been sufficient to cover the losses, right? So these are not crazy numbers relative to, say, Basel III or what the FSB is proposing. And maybe it makes sense to actually go with 22% constant and not try to move it around. Now, there are two caveats before you can take this result. And one of it, this would be the right computation if all the banks had the same losses. In fact, there's a distribution, so it's clear that for some banks, 22% will not be enough. And then the other is, when in this case, suppose that all the banks were the same, the capital ratio would be incredibly small after. And then basically a regulator would have to still say, you have some time to go back. But I think it says maybe we want financial regulation in many cases rather than things which move, but can't quite move well. Let me move to the second issue, which is the inflation target. So I think we have to accept the notion that the higher is average inflation, the higher are the average nominal interest rate, and therefore the more room you have before you actually decrease the rate to zero. I think that's arithmetic. I don't think we can be argued. I think that we fine. Good. So it's clear that all things equal, if you have high inflation, it's good in the sense of decreasing the probability of getting to the zero overall. Now, it looks like a crazy way of avoiding it. You basically impose high inflation all the time in order to avoid that risk. And inflation comes with some distortion, probably not much bigger at 4 than 2, but they're there. So the question is, are there better ways? And here I'm going to basically play against myself. I've been advocating a higher rate of inflation for that reason. But I thought of an argument which says, well, maybe 2% is something good, and maybe it's still worth it. Which is that what has happened, and it's very striking, is that at 2%, inflation stops being salient. Basically, when inflation is 4 or 10 or 20, when people spend their life trying to basically guess what the real value of the mortgage is going to be, what the wage. No, it's not symmetric. Let me go back and then review that. It's all combinations by nature. So, again, when inflation is 2%, and if you ask people who are not economists and not financiers whether they care about inflation,
this is a
they basically will say that they don't care this one. Now, this has an implication, which is, I think, that it anchors expectations. They basically assume that inflation is going to be 2%. Actually, a number of people think it's going to be 2%. For me, it's very, very high. And that's a very good thing.
anchored expectations makes monetary policy much easier. And I think that what we're seeing, and central banks would like to credit it to credibility of the target, but I think it has a lot to do with the lack of silence, which is the case. And so at 2%, you basically have anchored expectations that helps a lot. At 4%, you may lose it. I think that's an argument against going to 4%. An argument which I think is completely unconvincing is that going from, which is very frequently given, is the loss of credibility. The notion that moving from 2% to 4% would destroy the credibility of central banks. You know, central banks have changed the way they have done monetary policy by orders of magnitude in all kinds of dimensions over the last 10 years, and they haven't lost credibility. So if they could explain why 4% is good, I'm quite sure it could be done without the loss of credibility. So I think the case is still there, but I've given you an argument against it, which I think is relevant. Now, are there better ways? There's been a lot of very creative thinking on these issues by William Boyton and other people. One is to forbid cash, so that we only have checking accounts in which the interest rate could be negative. I don't think that that can fly, both from a political and a legal and practical way. Getting out the combination. And then the other is a scheme in which you have a different medium of exchange, and which has been used in some countries where there was very high inflation, but it's clearly conceptually much too hard for people to understand. It goes nowhere. So I think the issue is there. I'm not pushing for a high inflation target, but I think the case is very strong. Now, the computer really wants you to see this slide. So what this does, what this shows you in red is actual CPI inflation, and in yellow, the consensus forecast for 10 years ahead. And you can see the incredible anchoring that has happened. Basically, the yellow line doesn't move anymore with the red line. That's a major change. And if this were to go away, monetary policy would be much more complex. Let me move to the next to last. So the third is how to deal with high public debt. And I think here we have to accept the notion that public debt is high in many countries, and it's around 100% of GDP in most countries, sometimes higher. And that it would be good if it were lower. But it's not going to happen just by itself. With low growth and no inflation, basically you're not going to have very much of a decrease. And so the issue is fiscal consolidation or fiscal austerity. And that's a debate in which I've been involved quite heavily. But it seems to me that the argument is a very strong one for limiting fiscal consolidation when the economy is doing poorly. And the reason for this is that the trade-off between consolidation on one hand and output or activity on the other is incredibly unattractive. Basically, in order to get a bit of a decrease in the debt to GDP ratio, you have to have a very large decrease in output due to the fiscal consolidation. And the trade-off is really such that unless you desperately have to do it, you probably should not do it, or you should do it incredibly slowly. So here I have a formula, which I'm not going to go through, but this is the formula for the change in debt as a function of the fiscal consolidation. I'm not going to go through it, but I'm going to show you this graph, which is based, I think, on parameters that most of you would accept. It has multipliers of 1, which are not crazy. It has a debt to GDP ratio to start with 100%, which again is what we see. And then the question is, suppose we have an increase in the primary surplus or decrease in the primary deficit of 1% for 1 year. What is the effect on the debt to GDP ratio? And the effect on the debt ratio is actually to increase the debt ratio for 2 years. And the reason is that debt decreases a bit, but GDP decreases more. And so for 2 years, it goes the wrong way. After this, it starts going the right way, but it goes the wrong way. What is the effect on GDP? Well, it's a fairly large recession, or
at least a large decrease relative to whatever baseline you had, you basically have the first year 1.5 or 1% less output. In the second year, you have about 1.5% less output. So you decrease that by year 5. You decrease that from 100% to 97%, and you've had a very long recession. Now, politically, is it feasible? Probably not. People are not going to give you the time to do it. Even in year 2, look at the trade-off. In year 2 years after you started, you have a higher debt ratio, and you have a recession. And by then, there are elections, and you lose. So eventually, it works, but it takes a very long time, and it comes with a strong effect in our field. So I think the conclusion is, yes, we have to have fiscal consolidation, but we really should limit it as much as we can when the economy is improving. If you have an economy like yours, in which there is growth and the private demand is strong, you can do more fiscal consolidation. But the way it was done earlier in various European countries, I think, was counterproductive. And that's the example of that. So if you just go back to the slide. The last point, I think, is one of them, which is suppose you decrease that from 100% to, say, 97% after 5 years. If you had credibility at 100%, you have credibility at 97. If you didn't have credibility at 100, you still don't have credibility at 97. It's clear that these ratios change too slowly to really change. So what's really important, and that gets to the other side of this, is that the way to fiscally consolidate is to have a program showing that you will not let that explode, rather than trying to have fiscal consolidation at the start. So the first point is, I think we have to accept the notion that we're not going to be able to decrease debt to GDP ratios to reasonable levels, say 60%. I was going to say in our lifetime. We'll have different ages, but in a long time. And so until then, I think we basically have to have credible fiscal paths, but not incredibly ambitious ones. It's just going to be very difficult. The second is, how do we maintain credibility? And I think what we've learned from the debate about Roloff, Reinhardt, and others is that there's no magic debt to GDP numbers, 60%, 90%. These are not relevant. What the markets care about is, do they have a plan to actually get somewhere? And so for this, what you need is what we call a debt sustainability analysis, in which you basically show how eventually you will basically get that under control. Ideally, we do a stochastic debt sustainability analysis to show the risk. But I think from a technical point of view, that's the way to do it. How to actually explain this politically is hard, but that's clearly the way to do it. Just having fiscal consolidation is not by itself the way. 2 points at the end, not directly related, but related. The first one is, there's an old idea, which is GDP bonds. So basically bonds which trade up and GDP growth is high, and bonds which pay nothing when GDP is zero, GDP growth is zero, negative, if growth is negative. And these are, I think these are feasible, and they decrease the risk of debt explosions in a crisis actually. If you do the counterfactual of what would have happened if we had them in place, we would have low GDP, debt to GDP ratios. From the risk point of view, second moment point of view, they can really help. And they, Bob Schiller has pushed this for a long time. I think we should revisit it. The other thing is thematic stabilizers. And here, again, I'm going to shoot myself in the foot, because I've been arguing for thematic stabilizers for a long time. Let them work. But there's an issue with the thematic stabilizers, which is that they respond to output movements, not to movements in the output gap. So another way of saying this is, if you have a decrease in output,
I think Professor Arrow would call this unlearning by doing.
Okay. So I think I can go by the next slide. So suppose that there is a decrease in output. It's a temporary decrease, so potential output hasn't changed, and it's going to go back. This is the case in which you want to use the balancing stabilizers. But suppose that the decrease in output is a decrease in potential output as well. Then you're never going to go back, in which case you should not use the balancing stabilizers. So if we were able to say, well, this is clearly a decrease in output relative to potential, there's an output gap, we use that. If not, we don't. It would be great, except that our uncertainty about output gaps is gigantic. There's one of the slides that you will not see. It shows you the change in the perceived output gap in 2007 as of different years. So in 2007, basically, most people believe that the output gap was negative, that output was below potential. If I look now at the 2015 estimate of the output gap in 2007, it is large and positive. History has been rewritten. Right? Now, I don't know if it has been rewritten right or wrong, but it has been rewritten. So that in real time, knowing exactly what the output gap is a big issue. So I don't think we should give up on automatic stabilizers, but we should be deeply aware that they are more difficult to use than before. Okay, let me move to the last issue, which is you get to the zero lower bound, and the economy is still doing very poorly, and you still need to do more. Now, traditionally, what banks have done, what they have done in this crisis, is buy assets, other assets than the assets that were buying traditionally, with the idea that this would decrease the premium on these assets, decrease the rates, and this would affect activity. And this was seen as a very natural continuation of buying short-term assets before we just go to long-term assets, pretty private assets. And the logic of it is very clear, you want all the premium to come down. But there's clearly something else you can do, which is you get to zero, and you still want to increase spending, and you can buy goods. Now, let me be clear, I surely don't want the central bank to buy goods, for reasons which I'll come back to. But in effect, the central bank can buy goods. The way it happens is the government has a fiscal deficit of some size. It's an agreement with the central bank that the central bank will buy the bonds and issue money. Now, if you put it together, it's exactly the central bank buying goods, but politically, in terms of decision making, it's completely different. Right? I don't think you want the central bank to be involved in anything like buying goods or sending checks, but this can be done this way. So you have these two alternatives. Now, which one should you choose? I think we haven't asked the question in the crisis, until recently, and Andy Haldane, I think, has raised the issue at the bank. But we should. What are the pros and cons? Well, the first one, if you buy assets, you have some effect, you decrease some rates. You're not quite sure the effect of these rates on activity. You're not sure whether decreasing the premium on long-term bonds is going to have a large effect on investment. You won't. But it may. And that's kind of what monetary policy has done, extended, so it's a natural. At the same time, I think what we have learned is that one of the ones with quantitative easing of this sort is that you change the premium in the markets in ways that the investors are just not used to. You create a lot of uncertainty about the pricing, which I think has a cost. Investors are used to thinking about intervention at the short end and they have to think about it, and all these discussions about the decompression of the term premium, which is a big issue, and we don't quite know how it's going to work. So you, I think, introduce a lot of uncertainty in the financial system when you do this. Now, if you buy goods, what are the pros? The pros is you buy goods. And so the issue was demand, you've solved the issue, right? Or if you send a check to people that want be spent. So you get an effect that you're sure you're going to get the effect. The problem is that when you want to undo it, you don't have anything on the balance sheet that you can sell, right? And so the point is what you do then, and either you basically reduce the money supply in some ways, but this might be contractionary, or you let inflation basically take care. If you decrease your money supply, you just let inflation. Maybe a boost of inflation for a while may actually not be a catastrophe. In that context, we're talking about environments in which things are going very badly. You got the increase in spending. You get some inflation for some time, which does good things to the debt to GDP ratios of both public and private agents. And so it seems to me that at least from this point of view, it is not entirely clear whether we went the right way. We should not, next time, we're in the same situation, we should not go the other way. There are enormous amounts of credibility because in the past, money finance and deficits has led to hyperinflation. So it has to be incredibly clear that the fiscal deficit is going to be some size and not more. The bank is not going to monetize anything that the Treasury wants it to monetize. I think that can be solved. Again, I would make the point, given the UK context, that this is a discussion not about what should be done today or in the near future, but what should be done if we ever got back to the $0 bound with a very high level of unemployment and risk that things get worse. I don't think you are there in any way, shape, or form, but if you were to get there again, I think that's an issue which should be considered. Let me end. So, conclusions, these are more odds and ends remarks again. I mean, there are many issues which I initially on my slides, which I decided I didn't have time to deal with, but let me mention three of them. The first one, which is more relevant for emerging markets, less complex economies, is capital flows. I think what I've learned from the crisis is that capital flows can be incredibly disruptive. When they come in, it is a gift of God, but may not be a gift of God. Basically, it will lead to all kinds of excesses, and then it goes out, and it's even worse. And so the question is whether it makes sense to have them in the first place. I think we have to rethink this one. The second is whether we should use monetary policy for financial stability. So when we see risks to the financial system, I've talked about macro pool, but should we in addition increase interest rates in order to limit risk? I think that the fund just came out with some work, which I fully agree with, which is that it's just not the right instrument. The interest rate is just not the right instrument to deal with financial stability. Macro pool is, and if macro pool doesn't work, I'm not sure the interest rate will help them very much. But that's clearly a big issue for central bank to deal with. The last one is the provision of liquidity. So in the old days, when there was a bank run, banks would get liquidity from the central bank, and it was all fine. What we've learned is that there are many institutions which are not banks, which may need liquidity. Any institution which basically has a maturity mismatch may need liquidity. And the question is, who do you extend liquidity to in those circumstances? And that's again the tough one. Not a clean answer. You don't want to go too far, but you have to go beyond banks. So let me end there. I mean, this doesn't add up to this is exactly what should be done. This is a set of questions and partial answers, but I need something to do for the next few years. So we start here.